Welcome to the Gray Report. We've got the whole multifamily market and the economy. How's it? We've got it all figured out. We're going to break it down to you, what we know, the few things that we don't know. So you want to stick around for the full episode. Make sure you're subscribed to the Gray Capital YouTube channel. It's been a good episode. Let's get into it. Welcome back to the Gray Report, joined again by Director of Communications and Marketing at Gray Capital, Dr. Matt Bosnagel.
Hello.
Also producer of the Gray Report, and I'm also author of so many of the awesome research reports that we published here at Gray Capital. Matt, we've got a really interesting show today, talking about multifamily, we're talking about housing, we're talking about the economy, a lot of changes. We're talking about cycles, business cycles. We're talking about, again, a little bit of changing of administrations or just some of the political changes and the perspectives that are shifting, sentiment that we're seeing shift. But one thing I always like to ask as we jump into, because you put a lot of time, not just putting together the Gray Report and what we touch on every single week, but you're also drafting the newsletter, the Gray Report newsletter that goes out every Thursday at 8:30 in the morning. GrayCapitalLLC.com. You can sign up for that newsletter. So you've got a really good sense of where the market is. Just getting through, putting together the whole week. What's your take on this week in the multifamily market?
Yeah. It looks like, as much as people like to wait and see, I know we love waiting and seeing and kind of hesitating and uncertainty. Things like, I think people are working through some things. I think that whether, they're kind of moving forward in a way that, it might belie the current, whatever the media is saying about a lot of speculative things that may or may not happen. Nothing's crashed yet. And actually, if you look at the long-term numbers, things are pretty positive, all things considered.
Yeah. I've gotten a similar feeling, really maybe not just this year, but call it the last 9 months or so, where I felt in our mind or my mind and the team's mind, I think we had a little bit of clarity of where we needed to go, at least where our local markets, where they were, and we saw things really kind of stabilizing and continuing to grow. And the picture is a little bit clearer versus if we're in the Midwest. So if we were down the Sun Belt and if we were seeing massive rent declines, we might have had a different perspective on where everything was. We're not seeing the distress, the volume of distress, which is not at massive volumes anywhere. It's very pocketed and it's one-off. It's certain property types, certain operators. But I was getting this sense that I've just, whether it's on LinkedIn or talking to other operators, this sense of fear and the idea of that we're fighting the last war. Yeah. And at some point, we spent a lot of time talking about this last year, but there's not going to be an all clear sign. Yeah. There's no one, Jay Parsons isn't going to come out and say, guys, now's the time to start investing in apartments. But if you listen to Jay Parsons, he actually kind of has been saying that for a while now. But there's not going to be any all clear bulletin. Now is a good time to get back into apartments or in any asset class in investing. And there's risk of being too early. Yeah. And you could call the too early the folks that were doing deals in 2021 and in 2022 when things were, seemingly all really great and we were going to get all this growth. But it was before the supply wave and before.
It's too late.
It was too well. It was
too late for the one.
It was too. It was a combination of being too late, too early. Yeah, and they're dealing with the ramifications of that. And so now, we've got operators and investors thinking we're in that same situation. Yeah, we're just stuck because it's paralysis by analysis of, is there a cap rate that makes sense? Is there an interest rate that makes sense? Is there an amount of supply that makes sense? There's all of this to analyze. And, as you want to be one of the golden rules of investing is you want to take emotions out of the investment process. Spent a lot of time focusing on that and working on that. One thing I've learned, though, is that it's a little bit of a fallacy of taking emotions out of investing. Emotions are always present. Yeah. And you really have to manage your emotions and understand what they're telling you. But it's really managing your emotions and not letting fear creep into creep to a point of where you're truly immobilized.
Yep.
And everyone wants to get the good deal. Everyone wants to be the grave dancer like Sam Zell.
Yeah.
Everyone wants to buy the distress deal, especially the like great location, perfect deal, at the deepest discount, pennies on the dollar. And it's not always that simple.
Yeah, yeah.
And
well, and also because what we're seeing is not a dramatic change where it's easy to notice. Some of the stuff, especially in the multifamily market, things don't swing wildly as much, and they don't usually swing wildly, except that they did in like the early 2020s. I still think though that these long-term changes, the gradual change that we'll talk about, like in the labor market, and in just the change right now that we're seeing in multifamily as it slowly recovers, if you don't notice that uptick, and if you think that things are still stagnating when they might be in a more optimistic or positive direction, then you might be on the wrong side of it. You might be too late.
That's my impression. Now, the one thing that I still think that could be coming down the pike, we've talked about this last week, is there are a lot of older deals. These value add deals, or that have either the business plan hasn't been fully executed, or it was apparently executed over and over and over again, to where it just got bid up to a price of you're paying almost the price what it would cost to build a new property. You're buying a 1970s built asset for that same price.
Yeah.
It just didn't make any sense. So there are a lot of loan maturities at the end of the year. Those still have to cycle through the system, and there's a big question of who's going to buy a lot of those assets, because it's hard to get insurance on a lot of those older deals.
Yeah.
And I've made a point to say I think there's going to be a huge opportunity in that space, but like there aren't the deep discounts, and there's really no guarantee there's going to be. When I say there are discounts relative to a couple of years ago, but the idea that you're going to get, anything in a decent location, above a 6 cap right now, it's just not happening.
Yeah.
Even getting assets in a good market, that's a decent asset that doesn't have a ton of physical obsolescence, and it's hard to get insurance. Very few deals are trading well above a 6 cap. Now, like if you go on CoStar, they say deals are trading for 6 or 7 a cap, but that's just not correct.
Yeah, I wonder how the this will shake out for B or A class. Like we've always said, a new apartment comes into the market, it actually does. And it seems trite, and like it does kind of trickle down to C class, a new apartment, and it does raise or lower the rents of all classes of apartments. Eventually, I don't know what the time frame is, but like it's been proven, new apartments come in, and suddenly, actually, the older apartments are going to get cheaper as well.
Well, and there's a lot of nuance. So like that has been proven to be the case, but it's also relative to just like what the total new supply is. So if there's just one new apartment community that's coming online that's brand new, and there's nothing else like it around, and you're charging significantly more in rent, well, there might be demand for that product type.
Yeah.
There was that product type that didn't exist in the market before, and then that fills up without having to lower their rents. And that could then have the effect of raising. This is in a supply-constrained environment where they need more supply, but they're not getting it. Because then the B class apartments say, "Oh wow, we've been renting for $1,200 a month. The new A class is $2,000. I bet we can get $1,300 because there's such a big gap between the two. And hey, maybe we'll throw a granite countertop in, and we can get $1,400, and we'll still be significantly."
My question is, if that that kind of dynamic exists, would it exist on the investment side, wherein very cheap C-class apartments make A-class apartments cheaper? Does it happen on the or are those so much of a different market? The value-add people aren't really buying the super nice luxury apartments. I'm not sure if it happens in the same way, but it should if economics works.
Well, there's certainly like correlated just to some degree. Okay. I mean, like if at some point, if you can buy let's say an 80s built property that's in like decent shape in an okay location, not like great, but like okay enough. If those prices come down to let's be dramatic, and let's say they go to 8 caps. Well, who's buying a new deal for a 4 cap or a 5 cap?
Yeah.
There are some folks that just don't want to deal with the headaches, and maybe the 5 cap's okay. And this is what I've told our investors, and I made a couple posts on LinkedIn that like we've done plenty of older acquisition, older properties, value add, more workforce housing deals, and we've gravitated for operational, but also just for like fundamental reasons into newer properties. For again, because we thought the risk return profile honestly made more sense.
Yeah.
But there's a point of where the older properties become attractive, because at the end of the day, at least the way I look at real estate investing is, income generation. And I'm a cash flow investor, and not all, most real estate investors are investing for some sort of yield or cash flow. Not all, believe me. There's speculators, developers who are no cash flow, massive value creation, and bam, I'm going to sell it for a big pop. Where we're looking, typically, it's like we want to get 50% of our return from cash flow and 50% of return from value appreciation.
Yeah.
Or at least that's in an ideal scenario. If you can get in, but the problem is cash flows have decreased because cap rates have come down. And so your yields, instead of 50-50 yield in capital gains, now it's like, 70-30. 30% yield, 70% of your upside is from capital gains.
Selling it more than you bought it for.
And that is okay. That's fine in theory, except cash flow investors, as it's not a rule, but the way that many of them think, and this is kind of how I was like kind of raised and brought into this type of investing, is that upside is, speculative. You don't really know. Yeah. Now, I'd make the argument you don't really know about any of the cash flows. And I saw a post on LinkedIn, I think it's CRE analyst that did it, and the part of it's yield, part of it's speculative capital gains. There's also speculative income. That means that how am I going to operate it? Am I going to increase the rents? Am I going to decrease expenses? Combination of those two, I'll increase my cash on cash yield. But you're speculating on how much you can increase rents, and you're speculating on how much you can decrease expenses.
Yeah.
But you still, even with that being said, the cash flow is is less speculative than we are going to sell it at X cap rate in 5 years.
The definition of, if that's the cap rate, then it's defined by the cash flow, so you kind of can't get away from that.
Exactly. Can't get away with it from it because it's based off of net operating income. So what I'm getting back to is, if those older properties that again are hard to get insurance for right now, where the insurance is very expensive, they're harder to manage, dealing with evictions, collections, bad debt, very operationally intensive. But if you're getting an 8% cash on cash return, or even a double-digit cash on cash return the first couple of years, you could easily, and many investors will say, yeah, I will go and do that deal, and I'll deal with the headache. So I think if there's obviously a point of where the higher end deals start to decline in price because the older deals are getting so cheap.
Yeah.
There's also buyers that are going to jump into those older deals, but they're just not cheap enough now. And it's the reason why we started doing more core plus deals, newer properties than older value add deals, is that the cap rates on the value add deals were sometimes lower than the core plus deals, or they were about the same. And so this was 2018, 2019. We started, after we were pretty much doing all value add deals, and then we started looking at some newer deals, which we thought never would make sense because we just thought the returns would be too low. But the cap rates on the newer deals were like the same as the older deals.
Yeah.
And you're speculating on income either way. You're speculating on income from the value add, saying we're going to put this into it and then we're going to be able to raise rents. And now there's more volatility in that. Like how well can you execute? How quickly can you execute? You're bringing all this extra capital on. That's risk. That's more money you're going to have to pay off on a return. And, so the end result of that is a question mark. Now, it worked so well, not because everyone was executing so well on value add deals prior to 2021, but cap rates were compressing at the same time. So you could do an okay on the execution. Or what we found in many of our deals is that we were getting our targeted rent premiums without doing the actual renovation.
Yeah.
So we said, like, we need to renovate half these units. We're going to put $12,000 into each unit. We're going to raise the rents by $250. We'd buy it, and then we'd be like, well, let's look at rents. We know we're a little bit under market anyway. Let's just move the rents up $250.
Yeah.
And then everyone just started accepting the rents. And we started leasing units. We just released 10 units at our premium. You know how much money we did put in? We just did a turn. We did do a heavy turn.
This was early, or like during the peak, during the big rent growth era, or
no, before.
Yeah, interesting.
Before. Yeah, this is pre-pandemic.
Yeah.
This is 2017, 2018, 2019.
Yeah.
And so like you're like, wow, we did really good on this value add. And it's like, yeah, just there was so much organic growth.
I just keep thinking of a very old building with a lot of deferred maintenance, a lot of things that need to be fixed, a lot of problems that you're going to inherit. And sometimes I wonder, like, you're going to pay that much, but then you're going to have to pour more money into it. And how much, like, is there like a negative cost ever that, like, so that's sometimes I
what was then the case was then, so you try to at least cure the deferred maintenance, but like sometimes, and we did, I feel like we could, in that period, I was doing a lot of like co-GP investing. Great Capital wasn't doing as much of our own lead sponsor stuff. We hadn't started our own property management company. And, so we were still curing deferred maintenance, but, we would selling it to the next group for, I remember selling a value add deal, 70s built, like early 70s built in Indianapolis for like a 3.9 cap or a 4 cap.
Yeah.
And it was one of those that, we had done really well on it. We had like fixed the laundry room. We had done cure a lot of deferred maintenance, but we weren't throwing money into the units because we were getting our income was exactly where we needed to be. We didn't think it was a great use of funds. Well, so then the next group came in, they were like, well, look, all these classic units, we can get another $200. We had just raised the rents $250.
And that's what I always think is the interesting aspect of this is like part of the marketability of an apartment is projects that you didn't do. Like, oh, you don't want to, and Addison has explained it to me too, is like, no, actually you want to leave some unrenovated so that the next guy is like, gets greedy and wants to renovate them himself.
It's the art and the science of the sale and multifamily. Yeah. So interesting because, let's say you're selling a single family home. You're selling your house, your single family home. You're trying to get it ready. You're going to stage it. Yeah. You're going to make sure that you do the lawn. You mow the grass. It's clean. It looks like as good as possible. Multifamily, it's much more nuanced than that.
Yeah.
Because you don't want to show any red flags. You don't want to be like, oh, there's drainage issues or big dollar ticket items, but showing that you want almost the buyer to think that there's things to improve. Yeah. Because when they see easy things to improve, they see dollar signs. Yeah. They're like, well, we know we could do that better. We know we could do that better. And so like where you'd think you'd come in, you'd see the sign crooked and you'd straighten it. Whereas like you're selling a multifamily deal, you might see the straight sign and you might make it. I've never done any of this. I'm just saying that this is talked to enough brokers, and it's an interesting it's an interesting process in the psychology behind it and what a multifamily buyer is looking for. And an experienced multifamily buyer, and there's layers because I'm the very novice multifamily investor. They're looking around and they're like, the sign's crooked. Yeah. Like, oh, they're not managing well. It's like, well, we're going to manage it. So like, we'll straighten the sign. That costs $0. Let's look at actually the drainage, and let's look at how they're signing leases, and let's look at how they're doing deferred maintenance, all these other things, rather than some of the cosmetics. And then the next step is like, okay, you're looking for things you can improve, which you always want to do. Identify those. But then the next step is being aware that some of those little minor things may be BS, and you kind of also have to discount that and know what game is being played to try to figure out what's important and what's not.
Yeah. Very, very interesting.
Because there's a fallacy out there often that's like, we'll just manage it better. And that is a strategy that absolutely can work. But can you manage it better? Yeah. How exactly? Straightening the sign is not the plan. We're just going to be on top. We're going to hire better people. You have to have, it's really what are your systems and processes that are better than.
Yeah. Oh, a lot of risk. Yeah. It's going to be interesting, but it'll take work. That's fine.
Yeah. Let's talk more. John Burns, Research and Consulting, because we have a lot to get through today, Matt.
I can make this as quick as we need to be.
Where are we in the housing cycle? 2025 addition?
Yeah, so this article lays out the premise that there are these phases of housing development, and you can. I'd love to get your insight here after I run down these and how it relates to this overall kind of idea of business cycles. But as this article lays it out, the housing cycle progresses from the bottom of the market to recovering, to growing, and then you plateau, and then it's a slowing market, and then it's a falling market, and then you're back to the bottom again, just kind of in a neat little circle here. At the bottom, you have distressed capital investing, low volumes, weak pricing, and recovering as demand stabilizes and pricing environment is improving, and then things improve until you get to a plateau where things are starting to fall, and then you fall, and then you're bottom again. I kind of flew through those, but you kind of get the idea. I do think that there is some assumption here that that the conditions of one of these phases automatically flow into the next, but that's a discussion I'll save for just a little bit. I am curious, Spencer. We spoke about this a little bit before the episode about how this may relate to business cycles and the idea of cycles in general, and because some of the assumptions in here are like the way that I understood this, and I watched a video that they had connected. Yeah. They had a 2008 video where two houses were talking to each other, and a grandfatherly house was talking to a child house and saying like, "It's okay, little guy, you'll get sold soon." And I was like, all right, that was funny. But yeah, how does it relate to the idea of business cycles and debt cycles? And like, am I missing something here by assuming that this cycle just flows in a perfect circle all the time?
Yeah, so I think that's the fallacy in that it's not like a perfect cycle. It's not a perfect sine wave.
Yeah.
If you're looking at like cycles or waves, if you look at like an audio source, of a sound, if you look at it, you spin it around the computer and you look at all like the waveforms, there's a lot of different, the line going up is like positive voltage, and it goes down, it's negative voltage. There's a lot of they're not perfect sine waves. Yeah. There's cycles within cycles, periods within those cycles, and because there can be a lot of different things going on in a system.
Yeah.
So business cycles are used to try to understand the path of the economy, looking at the past and identifying that there are different cycles,
booms and busts.
Exactly, it's a boom and bust. And so this was like the predominant way of looking at like the economy, kind of especially like in the early 20th century, and especially kind of leading in and just after like the Great Depression. And it was later that like the Chicago School really started focusing more on the money supply, the monetary system, as being a major contributor. But similar as we're going to talk throughout the episode of, what's the primary driver here? Like we're going to talk later about, is it employment growth? Is it supply? They're both important, but some can be more pronounced and have a higher impact. And it's the same thing with different cycles. There are debt cycles, there are real estate cycles, there's the general business cycle, and these cycles can have different lengths and period lengths. And so like the real estate cycle, is thought to be, and again, it all changes and averages, and again, it's a soft science, right?
Yeah. No.
But the real estate cycle is typically longer than like the stock market cycle, or even like the general cycle of the economy.
Are you talking about on a national level or on a market level?
But all of that,
because
national level. So there are every city, every market, every submarket, you could track a cycle, and all those cycles are interdependent.
Yeah,
they influence each other. They can also have independent drivers. Like for example, a submarket in a suburb of a major city, if it has a ton of growth, that growth will have effects on those other markets. It will have its own cycle. It could be on a period of growth, whereas the neighborhood just miles away could be on the decline.
Yeah.
But then in the combination of those two affect the broader cycle of that larger MSA. Same that MSA going into a state, a region, a country, continent, and then the world. They all affect each other.
Yeah.
And so similarly, there is a general, real estate cycle and a rent growth cycle, and there are smaller cycles within that. Outside this like 25-year real estate cycle, we have annual cycles. We have leasing season and slow season, and the leasing season basically starts in March and goes through July.
Yeah.
And then it gets slow like every single year. And so there are other longer term cycles than that. So
They kind of it does kind of illuminate things for me because the way that I understood this initially, at least when it comes to individual markets, is kind of what our colleague Jay, the head of
it's our chief investment officer.
I'm sorry, but he talked about student housing, how the cycles there is like a bunch of rents will go. There's a scarcity, housing or apartment scarcity. They will all descend. A bunch of builders will descend on that market, build a bunch, and then now there's a glut, and then that glut will persist for a while, and then no one will build for a while, and then now we've got a scarcity again. Then they'll build again. That's kind of how I understood it in simplistic terms. I think that but now what informs me on the national level is the debt market. So the debt can be good debt or bad debt, and they'll want to build when interest rates are lower. And I think that that's what happened in the last couple of years, and that's why I think this chart is a little bit weird to me and harder for me to understand, because some of these markets, all of these markets follow the debt. They all built more when they could, and now they're building a little bit less. Now,
debt, and also the money supply. Also, how much actual money is in the system? That's where like the Chicago school came into place with Milton Friedman. Post Great Depression, really understood it's not just the business cycle. We have to look at the money in the system.
Okay, and what I'm positing here, and maybe can kind of correct me if I'm wrong, but I think some of these cities have faster cycles. Maybe some are slower cycles. Maybe a place like Phoenix is more reactive. Their highs are highs, their lows are lowers.
100%.
And on the other hand, there are some, I think, and we've kind of been making this point about like Midwestern markets where they don't maybe they don't get to the plateau stage even. Maybe they just stick around in the recovering and growing stage for a much longer time, and they may skip the falling or bottoming because they've just been so steady the whole time. I think so. That's my point, is like the stages, whether you reach all of them, that may not work on the individual market level. However, I do think that it makes total sense on a national level. Right now, we are just like on the other side of like an oversupply of apartments. So that's something that's experienced throughout the nation.
So just in apartments, we have this larger supply wave that's affecting different markets differently, but most markets to some degree, but then those individual markets have their own individual growth story that influences that. And so it's all relative, but you can paint a larger narrative that can be somewhat accurate, but then the more granular you get, you can find very different stories. And just again, that's why it's important to not just understand the market, but the sub-market, but then even going in more granular at times of like neighborhood by neighborhood or block by block.
Yeah.
Because I mean in Indianapolis, what's the cycle of Washington Street, or Washington Boulevard versus like Crittenden, Boulevard.
Oh yeah,
it's like, these streets are on different trajectories, and they're like not too far away from each other.
Yeah.
And Crittenden's a fine road.
55th in Guilford's a lot different than 59th in Guilford or 57th in Guilford.
Yeah, exactly. But it's true.
Yeah.
So, but in trying to have an awareness of these cycles and kind of where they are. Now, one question I had though for you, man, I don't know if you had this or found it or if they've got it on here. I was curious at looking at this chart that they put out last year.
No, I didn't look about. Yeah, that would be interesting to see if things have progressed. I know that other places have employed that, like the cycle schema to these two different markets and to the apartment market. I just didn't. Yeah,
I think John Burns does one every year.
Okay,
and so that'd be interesting to look on at the next.
If I can find it, I'll put it in the notes too.
Yeah,
for this
perfect. Because like I think they had like Indianapolis on the plateauing or slowing. Last year, and so then it slipped back because it's all of a sudden you get some new information. So it's not perfect because these are all like interpretations, and someone is not an expert in all these markets,
Yeah.
and they're having to use they're looking at data
Yeah.
that could be not even like fully correct.
Take Phoenix, for example. I don't know about the rent growth. Now, this may apply to the housing market in general, too, and I'm sure certainly it does.
Yeah.
But, like, if you're talking about apartments, I'm not sure if Phoenix is at the recovering stage. Maybe it is. And what is recovering? Demand stabilizing, pricing environment firming. I think that there's still a ways to go, if you slice it and look at different ways, and if you look at the, apartment supply, especially with some of these. But who knows?
So, Matt, looks like
Yeah.
builders, they've got some challenges for 2025.
Yeah. This was interesting to me because it informed some of the communications that NAHB have had with they've sent these memos to Washington about these different issues, and so I was curious about the stuff that they were talking about, how it lines up with their survey and what the challenges their members are facing. And I don't think that that the builders themselves are as worried as maybe the memo would indicate. Interest rates and building material prices are big ones, but my favorite actually is buyers expect prices or interest rates will decline if they wait. So, man, I mean, if the wait and see, they're as annoyed as we are. Yeah. So, in order though, for 2025. Now, interestingly, this chart is organized by 2024. But either way, I've got the
So the red is faced in 2024, and the blue is
I've got the order right here.
They're less worried in 2025 than they seemingly just faced.
Yeah. So in order now, the worry is interest rates, buyers' expectation of waiting, the cost of lots, and then cost of labor, building materials, inspection and other fees, inflation, media, economic certainty, and then gridlock in Washington as the last. I think that it's really interesting how things have changed. The 2025 stance, especially on gridlock, it went from 60% in 2024 to 30% now. Inflation, as a challenge, went from 80% to 52%. And economic uncertainty went from 59 to 39. I think the overall sentiment, again, is interesting in that the construction industry was thought to be under threat, or they were the ones. They sent this memo, NAHB, saying that the tariffs that were planned by the administration could have hurt them. But I think the overall economy is also kind of just working through things with the assumption that the administration would not knowingly disrupt. And that's just my assumption right now. And the stock market hasn't really gone haywire, and neither has construction, which he just passed these building materials like steel and aluminum. So that's part of houses.
Yeah.
So
I mean, the one thing that they were more concerned about for 25 versus last year in 24 were building material prices.
Very good point. Yeah.
But just marginally, 64% for 25 versus 57 faced last year. The one thing that it keeps standing out to me, and it's just showing up on this report as well, is just the cost of availability of labor, and that's one of the few that is up a little bit, just 64 compared to 61. But the labor market is still really tight. And I mean, I know we're going to mention that here when we talk about the general economy. But there's still a lot of jobs, and wages are like continuing to grow. Wages are like outpacing inflation. Wages have been outpacing rents. And that's generally, that's a really, really good thing until it can be a problem of getting into a wage price spiral. I don't think we're there yet, because I think everyone is like confused, as this survey is confused, of like, look, I thought that inflation was over. Looking at CPI, it kind of is, if you strip housing out, but then we've got building materials are coming back. We see, here that egg prices are higher, but it can just wait, wages are growing, which means that there's support for rents to grow as supply is receding. But it's something that we're just going to have to watch for this idea of this wage price spiral. Yeah. The one thing on tariffs, and I'm like, I don't like I just, economic warfare isn't good. Just let us trade whoever we want to trade with. But they will cause inflation. At least what I've been reading, it's a typically a transient effect, on like a one-time effect on inflation, and then it can even out.
Yeah,
but then also there's the idea that, like, well, maybe they won't come into effect. How serious, are we with these tariffs? How long will they be in play?
Mm-hmm.
And are we talking about we're going to be dealing with 3 months, 6 months, or we're going to have to be dealing with them for the next couple of years? And even if that's the case, again, it's like once it's done, the economy kind of absorbs it and figures it out. Again, I'm not really just as a philosophy. I'm not
Yeah.
really pro tariff, but
that is interesting.
sink us.
The idea of it being a set, because if it's a however much the tariffs are, seems pretty high.
Because again, it's like inflation is continued growth. It's like year over year growth, and if it just goes up once.
Yeah, that is interesting. And what I will say is that it seems as though the administration has been very responsive to to people that may, like it seemed. I thought we were getting our tariffs. We were getting our tariffs, and then it was like next month we'll get it. All right, and then
just enough to say that we did the tariff.
Yeah,
it's like, well, I did it. We got what we wanted.
Yeah. We can move to the economy if you want, because I would like to continue this discussion about job growth and jobs numbers.
Yeah, let's do that.
Job numbers, they say at the top of this headline that they have declined sharply in December to 7.6 million, which is below the forecast. I think that the job openings actually are still higher than they were pre-pandemic. Looking at the chart of job openings over the past 20 years, you can find that job openings, they were quite a bit lower in the past. I'm not factoring in population growth, but even so, we're not really at a danger zone when it comes to job openings specifically.
Oh my gosh, Matt, this is the lowest since September.
Yeah. And
available positions tumbled to 7.6. Again, this is one of those headlines where there's like no context.
Yeah.
And it's just numbers. Like, what is 7.6 million job? It's not even jobs. It's job openings.
Yeah.
What does that mean? It's just 7.6 sounds like a big number.
Yeah.
And they want to make it seem like we've lost 7.6 million jobs or something.
And we haven't. And
again,
we've got a chart
we're going back to September.
Yeah. We have a chart for the all employment, but I didn't pull up the chart for actual job openings. But even so, I can tell you that it is
the unemployment rate just ticked down to 4.1.
Yeah, the unemployment did tick down, and you can see right here for all employees, we're doing okay. Actually, I thought that we would continue to go down. So all employees. This chart here, it really peaked a few years, like what was it, April 2021, and it's been steadily going down ever since. These are employees added. There's a change from years ago, and so
it went from no one worked in the pandemic, and
so we were adding so many then, and it's been trickling down, but now we're adding just about as much as we were pre-pandemic, and it looks like we're actually where before we were steadily going down in the new jobs added, still not negative, but the acceleration was decreasing, and now we actually have flattened out and are starting to correct, maybe in the upward direction. All I'm saying is when it comes to employment, I'm not as nervous as I was before. Maybe in December and November, I could still see a future where things would still gradually stagnate and even decline slowly. But it looks like we approached like that asymptote or whatever it is, and we're kind of going up again.
I just zoomed in on this last year, man, and you're right. I mean, the totals were kind of like going up and down, but generally trending downward, over the last year. And, we just have really kind of three data points, November, December.
Three is a trend.
It's true. Yeah. So, we'll see if it continues.
Yeah.
But again, back to this cycles.
Yeah.
I mean, does this make sense? I mean, it's a pretty obvious cycle. Go negative, go positive,
and that's
rectify.
And just to kind of continue, like
biases
it's hard to predict because this cycle has been so gradual, or at least when it comes to employment, I don't know. There's nothing sharp for me to get scared about yet.
Well, and we're still dealing with the reverberative effects of the pandemic, and we turned the economy off, and then we kickstarted it with we choked up the engine, put a bunch of fuel in it, and then we poured a bunch more gasoline on it, and then we poured napalm around it. And we're like, like it influenced the situation just a little bit.
I just want to show you job openings really quick, because I think that it shows how volatile it really is, and how, look, we're still well above. We're still well above where we were. not really cause for alarm. I think that we may. So pre-pandemic, it was between 7 and 8,000,
Yeah.
and now we are between 7 and 8,000. In 2012, it was like 4,000. And these are job openings. In 2004, it was like 3,500. So we are about twice as much as they were in the early 2000s. No, I know population has grown since then, but I don't think that we are in a danger zone, and I think that we could arguably be we could be stabilizing when it comes to job opening. Now we're going to be between 7 and 8,000 now for the next several months or a year or whatever. I don't see it plummeting down, although, who knows?
Well, and there's going to be some more economic data that comes out throughout this week. So again, make sure you're signed up for the Gray Capital, the Gray Report newsletter. Find on the Gray Capital website.
Yep.
So we're going to be bringing you a lot of good stuff throughout the week. Let's shift to multifamily, Matt.
All right.
So we can kind of close things out.
Ooh, I wanted to note. I'll note it in passing. I'll make connections as I go. Consumer sentiment. I will summarize it really quick. Conference board had declining sentiment. Now Michigan has declining sentiment, and inflation expectations have gone up a lot as well. So there's a little bit of clouds on the horizon. Got to be realistic, and that's my point there. Before, I was taking heart in Michigan because it showed a gradual increase over time, but now it seems like things are a little shakier. So we'll have to see. Jury's out for sentiment. There could be a turn in the future.
The volatility, political volatility, economic uncertainty, even though the fundamentals, we can say all day long that they're strong, there's enough just people don't know how to feel about the situation, again, related to politics, related to their pocketbook, and that draws down sentiment because people are uncertain. It's hard to make decisions.
Yeah.
And I think we collectively here, we see a little bit of uncertainty as a chance for opportunity. Others, it could be the exact opposite.
Yeah.
So we were talking about job growth, but RealPage, they have a piece out saying they're saying that job growth is no longer the chief predictor of apartment rent growth. Again, this comes back to there's a lot of different variables. Which are the ones? How are you weighting these variables? Yeah. Some are consistent. Supply was much more steady a couple of years ago, but and the changes might be, a new business is bringing a couple thousand jobs to a market that has a much broader impact, an immediate impact to the rent growth and what kind of apartments. Now we need fancy apartments, we're going to have higher rents. But RealPage is saying, employment growth may not be the only thing you should look at.
Yeah. This was interesting. It does give us an information, like kind of a retrospective look at how job growth has predicted or not predicted rent growth in the past, and what it's like now. Time was you get 10% rent or job growth, and you may see above 10% rent growth, maybe even 20%. Wow. They've got the chart there, and it looks like you're growing rent growth a little bit stronger than the cumulative job growth. However, when it comes to apartment supply, I'm not sure if they're controlling that here. I think that they are, and I'm gonna have to contact the authors here. But that was my first reaction when I read this. Is yeah, of course, job growth's not the chief predictor. It's been apartment supply. The whole story of the apartment market. We built so much where it doesn't even matter what your job. We've overbuilt the prospects of jobs. That is, it was everything. The primacy of apartment supply is nothing that I really even need to remind everyone about.
But going just looking at the chart that we just looked at, I mean, again, it's correlation is a causation, but I'll do a correlation causation. I mean, we had incredible amount of job growth, in 2021. Well, that pairs really well with a lot of rent growth, and it's not like we saw supply decline during that period. We had supply starting to ramp up. I'm saying that it all matters. It's just, to certain degrees, and there are certain thresholds where one variable can overtake the other.
Yeah.
I mean, I could also say I'm going to correlate war zones with rent growth. Wars. It's not employment growth. If you've got a war, in your market, that's going to be a bigger issue. But
household growth. Yeah.
But we don't worry about which submarkets are going to be in conflict with each other in the United States because it's a non-issue.
Yeah.
Okay, it's an extreme example, but in the
past,
that's true.
Supply, that's a good point.
Supply was relatively
issues.
Exactly. The supply was stable, so it was a variable that didn't have a big impact. It's just you go back to if you've seen the movie Margin Call,
Yeah.
and they're packaging up all of these mortgages to bake into these mortgage-backed securities, and they could do it because the volatility was within a certain range.
Yeah.
And they're like, it was fine. Vol was low. We could get these. We have these crappy mortgages on our books for a month, but like volatility is so low, the prices don't change that much. It gives us time to package them up and kick them out the door. They never anticipated the volatility that could swing as widely. So all of a sudden, where volatility was something that we're aware of, but we're not really focused on it because it's just within a bounds. It's outside that bounds. It throws the whole system off.
That's what I was
thinking. And I think
too,
that's more of what's happening here. And it's RealPage and it's all the other folks that are writing articles. They weren't right. I mean, certainly we were always looking at supply or considering supply, but the articles that are driving the narrative are more on unemployment, not on supply, and I think there's a little bit of catch up. And because people are asking, they've told, no, not calling out anyone or any publication, but they've been telling everyone for the last decade to just follow the jobs and specifically follow the jobs to Austin, Texas. And everyone did that. But it's not working. Hey, so Matt, I'm at a stopping point. I've got a meeting that I have to hop onto right now. I've got a really important interview. So everyone, you're in really good hands.
I really want to say my piece too.
Matt has, I often derail Matt's notes and his thoughts, and then like I take it to a different direction, and Matt's like, I've got something like I really thought about. So Matt, the floor is yours.
All right.
And we do have a new investment opportunity, Walcott Apartments for accredited investors down in Jeffersonville, Indiana. Scheduled meeting, greatcapitalllc.com or Walcott Invest. Hop on a call with you, tell you about the new deal. It's exciting. Okay.
All right.
Thanks, everybody.
Yeah, just to close out this discussion of RealPage and a couple more things I wanted to note here. So yes, RealPage does posit that that job growth is not the only factor when it comes to rent growth. I think I think that we both know that, and I think that it has, this is a different time period in which apartment supply has become just like everything when it comes to the apartment market for the past few years. However, I also think it would be interesting to know if they do factor in supply growth, and they're like, well, for apartments with the same amount of supply growth, how does job growth correlate with rent growth? And I still think that it may become unmoored. I think that there is a point where you crank, and Spencer was kind of saying this in so many words as well. There is a phase that you get in, a different kind of environment in which if a supply is up here, then the normal rules may not apply. Maybe if you're adding like 5% or 10% to apartment supply every year, then the rules for rent growth are different when it comes to jobs compared to if apartment supply was increasing by like 2 or 3% every year. I just think that, and the same thing for rent growth. Rent growth was super high in 2021. Then in that way, there may be a different like motivation for people to get an apartment or not. I know in this article, it talks about remote work. It says, in a post-pandemic world where employees, especially highly educated, high-earning employees, are more likely to work remotely, a given market's job gains might be irrelevant to where those employees choose to live. I do think that remote work may be a factor, but I also wonder if we're just kind of in uncharted territory where like the physics doesn't work when temperatures are this high or something like that, where supply had been historically high, and that makes rents a little bit of uncertainty. Maybe it doesn't matter as much where you live if all of the markets just have a glut of apartments. So I just think that in these highs and lows, which we've experienced for the past few years, that might throw the numbers off. However, I think that it doesn't mean that jobs aren't a predictor of rent growth. I think that job gains look at how we've looked at household growth, look at population growth, and that's really important to look at, not only on a market level, but on a sub-market level, where you're close to and where those jobs are. So that's the RealPage article. And then just to close things out a little bit now, Spencer's not here, and I can return to this and show you the inflation expectations and how they have grown for the past couple of months here. So going from the expectation was around 3.75 or maybe what was it, 3.5, and now we're all the way up to 5 and above. I've seen other charts of inflation expectation separated amongst Republicans and Democrats, and the Republicans now think that inflation is going down, and Democrats think that it's going up. But in total, the ones that think that it is going to increase, whether they are Democrats or Republicans, they're outnumbering the decreases, or their inflation expectations are just that much higher in total. And when it comes to overall consumer sentiment, we've got a couple months here of declining consumer sentiment from University of Michigan that kind of now really does align with the conference board. And I was saying before how I was optimistic because, and I still don't think my thesis needs to really change on the whole. You see a long-term trend of improving consumer sentiment in University of Michigan. We've got a couple months of declining consumer sentiment, but that doesn't disprove the overall trend. And as I said before, 3 is a trend and 2 is not a trend. So I still have hopes when it comes to consumer sentiment in total. Now, the last thing here, I just wanted to note really quickly, and Spencer we had spoken about this before, so I'm going to kind of paraphrase his. So it'll be just like he's still here. This is Collier's snapshot of capital markets, and I'm skipping to the multifamily section. It's got figures for uninvested capital. And they're saying that investors are coming back to the multifamily market with a vengeance. These are Q4 figures, but that's only like a month or so away from today. So it's a pretty near-term snapshot of what the investment market is like right now. They said volume increased by a healthy 22% in 2024, leading all asset classes. Consistent monthly activity indicates the market has turned a corner. And I think that that's notable considering, so the consistent monthly activity means things are going by. They're not forgetting to buy and sell in the later months. It hasn't petered out near the end. So that's really that's comforting. That gives me a little bit more confidence here. They said investors are intrigued by the confluence of peaking supply-side pressure. So that means we've had this historic apartment supply wave, and actually it's on the downslope now. So it has peaked. Limited new groundbreakings due to elevated borrowing costs and the high cost of home ownership, keeping renters renewing at historically high levels. This results in a path to rent growth in the quarters ahead. This results in a path to rent growth in the quarters ahead. I think it's not going to be crazy, or may not even be above average rent growth, but it will be approaching a balance. And that's what hopefully I think and like I may have noted this in the Real Page article, I think that we may be returning to a period where job growth is again a predictor of rent growth. I think that we're heading away from a time period in which either rent growth or apartment supply is so big that physics doesn't work anymore. I think that the normal real world equations will start to work, and things will start to be really predictable because we're in a greater balance between supply and demand. Now, that may not be true in 2026 if the apartment construction really, really falls off a cliff. So we'll have to see if people continue to build in a high rate environment like it is. But I don't think the adjustment's going to be over. It's going to swing too much to make there be a huge scarcity of apartments. This chart, though, it shows stockpiles are being spent. It shows uninvested capital dropping from above 350, let's call it 375 million. That's billions of dollars, down to a little under $250 billion in 2024. So it was near its peak in 2023. This uninvested capital, maybe you can call it dry powder. I don't know. But in 2024, it fell off. People were investing. It could be the coffers are not filling up as fast. Maybe. Spencer also noted, in this high rate environment, it costs a little bit more money. You have to put up more actual equity in a deal, and the loan can't carry as much of a part in the deal. So you'll have to put a little bit more money in. And he said there's a lot of deleveraging is happening right now because of that situation. So I do think. And I think that Collier's point here is this is also a sign of, these are being spent. So this is a sign of more people are spending money in the multifamily market. I think that's a good sign. And the fact that multifamily sales volumes are going up, that's a good sign for a industry that really saw stagnating activity, really almost half the activity as it was that it was in some years than it should be. So we're seeing more activity in the multifamily market. That's great. I think the job markets, I'm not scared of them, and I think that the market probably will be coming into a greater balance this year. Nothing to be scared about, and I don't think that people are scared. So I think mostly I'll just continue to work hard, and that usually does the ticket for me. I do want to encourage everyone, and I will continue to be working hard tonight, gathering together a bunch of the best articles, research reports, and news items, and compiling them and sending them off in an email in the multifamily newsletter that we have, the Gray Report. So you can sign up for that. I'll have the link in the bio, or you can subscribe to the Gray Report. Follow us on LinkedIn, YouTube, wherever. Follow the podcast. Sign in. We'll see you next week. Thanks.